Hello and welcome to Fidelity's Outlook 2018, our thoughts on the year ahead. And I'm joined by our Chief Investment Officers for Fixed Income, Multi-Asset and Equities. And I'll start with Equities and Dominic Rossi. It feels like it might be particularly difficult to make forecasts this year. Am I right?
I think, well, let's remind ourselves, 2017 was a vintage year for global equity markets, pretty much up 20% in dollar terms across the board. I think what that means is that we've actually capitalized some of this year's returns already. So I think it's going to be a much tougher environment for equities in 2018 in terms of valuations. They already seem to be discounting pretty healthy earnings growth. So I think we'll be lucky to see positive returns from equities this year. That doesn't suggest there'll be a bear market or anything like that. I just think that we've had a good time, and I think equity markets will drift.
And yet earnings outlooks are sort of going up in a straight line still. So there's this tension between that and the valuations, which, particularly in technology, are extremely stretched.
Well, I think the valuations are already discounting quite a lot of that earnings growth, and I would expect the market in the late stages of the cycle to begin to derate, particularly as interest rates gradually normalise around the world.
Well, James, let me turn to you. So, your message throughout 2017, it seems, has been braver for longer. Don't get too defensive in this bull market too soon. Is that still the case then?
It is broadly. I think I share Dominic's concerns over equity valuations, but what I do think is that there's a reasonable chance of a small dip in equity markets and then a large move of cash into equity markets that rallies them up another notch. So am I looking for great double-digit growth in equities in 2018? No. Do I think they might be the best performing asset class? Yes, I think they might be. And therefore it is a case of being braver for longer. And I think, again, we have to contextualise versus cash, that typically late stage in a bull market, you either move to fixed income or cash. Fixed income isn't particularly attractively valued. We're early stages of a rate rising cycle. Cash is guaranteeing a return well below inflation. Therefore, why would you want that? So where do you go? You stay in equities.
Charles, you're head of fixed income. This is obviously your bread and butter. Do you agree?
Well, I think it's going to be a very interesting environment in 2018 for fixed income, because we are facing quite significant challenges. We have a challenge now that, on the face of it, central banks are clearly looking to normalise monetary policy. And when you talk about normalising monetary policy, it's about choking off some of the quantitative easing that's been going on within markets, and of course looking to raise interest rates. So you'd think to yourself, well, that's not a great environment for fixed income. However, we must bear in mind as to the pace of those interest rate changes. And I think every single central bank has been very clear that any interest rate rises we're going to see is going to be very slow, very muted and very controlled, because the last thing they want to do is upset what is still quite a fragile recovery.
You have different views on this about the pace.
One of the features of capital markets for the last 4 years has been the markets have always called the central bank's bluff, right? Markets have always declared you're not going to be raising interest rates as hard as you think. And frankly, the central banks have been wrong and the markets have been right in that each time. 2018, I think, is the year when, frankly, the central banks are going to be right. That the risks to inflation are now much more symmetric than they've been in the past. And the markets have been right in the past to guess that inflationary risk was down rather than up, and therefore that's why they got the interest rate cycle right. And I think the central banks are going to deliver on their interest rate rises in 2018, and the markets are still betting that they're not.
What about liquidity, Charles, as QE begins to be unwound in some markets anyway?
Well, I think this is going to be a fascinating feature in 2018, because nobody really knows. It's sort of unwinding and a new experiment, if you like, from the central banks. We just need to be much more careful about the consequences of this, because nobody really knows about unforeseen consequences of turning off that tap of liquidity. That liquidity is still going to be very much within markets, but clearly the tap is being gradually turned off. Now, already we're concerned within certain parts of fixed income, certainly lower rated credits, for example, that valuations are already quite stretched because we've had this very strong hunt for yield dynamic within the fixed income markets. And that hunt for yield dynamic is still very, very strong. But of course, what we have now is frankly, the marginal buyer being the central banks not being so active within fixed income markets, and therefore investors need to pay more attention on some of these overvalued propositions within the credit market.
So that's interesting. So cautious going into 2018 because of this experiment, the excitement around it, but that means you've got to be quite particular in what you do buy.
Absolutely. I think for us in 2018, that's going to be a key theme. We can't rely just on overall credit spread tightening driven by the amount of liquidity being pumped into markets by the central banks. What we need to do is eke out value for our clients by choosing the right credits, actually making sure that we are invested in credits with the appropriate risk return features.
James, if I can come to you, what's bubbling around in the background that you think might come to the fore?
So I think my biggest concern is an inflationary surprise that leads to central banks raising rates quicker than expected. That's going to have a reasonably unpredictable impact on all markets. And I think when we look at central bank policy, it's actually partly been sort of driven by a desire to prop up equity markets. And as that changes and that mentality changes, I think it could hit equities as much or more than fixed income. So that worries me. I think that related to liquidity questions, my big concern is you see a liquidity lockup in fixed income that leads to a panic in equity markets. And I think that is a plausible scenario that causes the end of this bull market. So you go from a world in which there's reasonable liquidity across all markets to one in which fixed income creates contagion in equities, and then you see a sort of a real re-rating of risk effectively. The third thing that worries me is volatility. So when I think about current levels of volatility, I mean, they are ridiculously low. And there are two reasons for that. One is actually people are quite sanguine about the environment, even when maybe they shouldn't be. But secondly, there's an awful lot of money betting on lower volatility and by definition pulling volatility lower. And any sign of a spike in volatility will mean that money unwinds, and then you get in a vicious circle of volatility spiking more and more.
Charles, fixed income world, if you'll forgive me, is usually glass half empty in the way that you view things. But what's keeping you awake at night?
As a fixed income investor, there are always two things that we're always worried about. First of all, there's a real pickup in inflation, and secondly, perhaps a big increase in defaults. As far as inflation is concerned, the big quandary really is about wage inflation. Despite unemployment being very low, we haven't really seen a pickup in wage inflation. But I don't think we should be too complacent about it. As in fixed income investors, we therefore are going to have a laser focus on this in the year ahead. And as far as defaults are concerned, defaults are actually extremely low at the moment because issuers have been able to term out their debt, i.e. they've been able to refinance and go for longer maturity debt. So defaults have been kept low. But if there is an increase in that area, that obviously will be a concern for fixed income investors in the year ahead.
James, what about, where does one go in a market like this? Where are the opportunities, do you think?
So I think that the one area that could be of interest is alternatives. And effectively that's saying the returns from traditional market betas are going to be muted, perhaps negative, perhaps positive, perhaps flat. And therefore, let's go somewhere else. And there's two areas within alternatives. One is alternative betas, so areas of the market that are just not correlated. So listed infrastructure, things like that.
And having to look much harder for that lack of correlation.
Much harder to find, much harder to research, yes. And the second area is things like long, short, and areas where effectively there is not a bet on the market direction, it's pure alpha.
And Charles, briefly, in that context, where are the opportunities?
Well, I still think it's premature to call the end of a bond bull market. But even with that in mind, I think we should enter 2018 being a bit more cautious about valuations. So there are still pockets of value. There are certainly pockets of value, for example, in the hybrids market and certain parts of emerging market debt, but we should be a bit more cautious.
So if I could characterise all of your thoughts about the coming year, it's that you're sort of quite gentle about the prospects for 2018, and yet that's not particularly what investors, what I suppose many of our clients are thinking. They're rather more nervous about the coming year. Dominic, why is that?
Well, I think it's been one of the characteristics of this equity bull market, which started in 2009, that it's been totally unloved. And frankly, by the time the market peaks, you would expect everybody to have fallen in love with it. So one of the reasons why I am more sanguine about the potential for around downside risk in the equity market is you don't have the level of exuberance that are typically associated with tops. But I think you would have to get you'd have to change your interest rate expectations quite dramatically before you would argue for a very severe move down in markets, or indeed a recession. And I really can't make a very strong case for either of those currently. So it's always nice to be, from a journalistic point of view, to have a dramatic story to convey, but it doesn't necessarily mean there has to be one.
Okay, well, thank you very much indeed, Charles, James and Dominic, and thank you very much indeed for watching. Goodbye.